Welcome back to the channel. Today we're going to take a deep and honest look at Zcash. Not just the price, but what's really driving it under the surface. We'll compare Zcash to other altcoins, analyze why it performed so well during parts of 2025, and most importantly, explain why that same strength could now turn into weakness. Because if you only look at price, Zcash looks impressive. But when you look at how the price moved, who was trading, where volume came from, and what kind of capital entered the market, the picture becomes far more fragile. This is not a hype video, this is a structural analysis. And by the end of this video, you should have a much clearer understanding of why Zcash rallied so aggressively, why derivatives dominate its price action, why leverage is the biggest risk right now, and why the long-term upside is more limited than many people believe. Let's start with the rally itself. Zcash didn't move randomly. The rally began in August 2025, at a time when broader crypto sentiment was improving, liquidity was increasing, and traders were once again willing to take risk in altcoins. At first, Zcash behaved like many other high-beta assets. It broke out of a long consolidation. It attracted momentum traders and price started accelerating upward. The first leg of the rally delivered a move of more than 500%. That alone is already extreme. But then something interesting happened. Instead of cooling off, Zcash entered a second acceleration phase, producing an additional rally of nearly 300%. From a distance, this looks like a classic bull market continuation. But when you zoom in, you realize something important. The drivers behind the first move were not the same as the drivers behind the second move, and that difference matters a lot. Let's compare this rally to 2021. If you overlay the charts, yes, Zcash went up in 2021. Yes, it had momentum. Yes, it had speculative interest. But this time, the internal structure of the market looks very different. Price didn't just go up. What really exploded was open interest, leverage, perpetual futures positioning, short-term speculative activity. In fact, open interest grew multiple times faster than the price itself. That's a red flag, because when price rises due to spot buying, that reflects long-term conviction. But when price rises because of leveraged positioning, it reflects temporary bets, and temporary bets can disappear very quickly. Let's pause here and make sure everyone understands why open interest is so important. Open interest represents the total number of outstanding derivative contracts capital that is actively betting on price direction, money that can be liquidated if price moves the wrong way. When open interest rises faster than price, it means traders are using leverage. Risk is increasing faster than value. The market becomes fragile. This is exactly what happened with Zcash. Price moved up, but leverage moved up much more. And that imbalance is the core problem. Now let's talk about who is actually trading Zcash. There are two very different groups. Long-term holders. These participants, buy spot hold without leverage, are insensitive to short-term price swings. Don't get liquidated. They believe in the asset over months or years. Short-term traders. These participants trade derivatives, use perpetual futures, rely on leverage, need constant liquidity. They care about funding rates, bid-ask spreads, short-term volatility. And here's the key point. Zcash is currently dominated by the second group. That means price is being driven not by belief, but by positioning. On average, funding rates for Zcash derivatives hover around 10% per year. That's expensive. So why do traders still use futures? Because futures offer high leverage, tight spreads, fast execution, low transaction costs. If you want to move in and out quickly, spot markets are inefficient. Perpetual futures are the weapon of choice for short-term speculation, and that's why the derivatives market exploded. Spot trading volume $131 million, perpetual futures volume $767 million. That means over 85% of trading activity is leveraged. Spot demand is a small fraction of total activity. This is not healthy. In strong, sustainable bull markets, spot volume leads. Derivatives follow. Here, it's the opposite. Now let's go even deeper. If Zcash were truly seeing organic adoption, we would expect high on-chain volume, many active wallets, real usage. But that's not what we see. On-chain volume. Near protocol, $9 million BNB. Smart chain, $36,000. Solana, $120,000. Combined, less than $10 million. That's tiny. Even worse, the most active pool had only 83 wallets interacting with it. That's not adoption. That's bots. Let's be clear. Arbitrage bots move capital rapidly, exploit price differences, do not hold positions, do not care about fundamentals. They add volume but not demand. So when we see activity dominated by bots, it means price discovery is artificial. Liquidity can vanish. Volatility increases. And that's exactly what's happening with Zcash. High leverage creates instability. When too many traders are leveraged, small price moves cause forced liquidations. Liquidations push price further. Cascades form. This works in both directions, up and down. Look at October 10th across the market. Massive liquidations occurred. Zcash was no exception. During the first rally phase, liquidations were modest. But during the second phase, when Zcash moved from $350 to $700, liquidations exploded. This was not organic buying. This was a short squeeze. Funding rates turned deeply negative. That tells us traders were heavily short. Sentiment was bearish. Market makers saw opportunity. So what did they do? They bought Zcash aggressively. Why? To force shorts to cover as price rose. Shorts got liquidated. Buying pressure increased. Price accelerated. Once the shorts were gone, market makers distributed into strength, reduced exposure, let price fall. And that's exactly what happened. This isn't unique to Zcash. It's a structural feature of derivative-heavy markets. Whenever liquidation levels cluster, open interest is high. Leverage dominates. Price will gravitate toward liquidation zones, not because of fundamentals, but because that's where money can be extracted. You don't have to guess. You can track this on coinglass.com. Here's how. Go to the liquidation tab, select Model 2, look for dense liquidation areas, short-term price of 10 moves directly toward those zones. Right, the market is relatively balanced, longs and shorts are evenly positioned, but that balance is temporary. Any increase in leverage on one side will create targets, attract market makers, move price aggressively. Now let's step back. Zcash moves in waves, historically above $800, then collapsed to $29. That tells us volatility is extreme, cycles are brutal part. 16. Inflation and market cap reality. Zcash is still inflationary. Yes, issuance has decreased, but the market cap is much higher than in 2018. That changes everything. It's much harder to move an $8 billion asset than a $500 million asset. When you plot market cap on a log scale, each line represents a 10x increase. Previous cycle tops align closely. This suggests diminishing returns, structural resistance, slower growth ahead. This doesn't mean Zcash is bad. It means expectations need to be realistic. At this size, 10x moves are unlikely. Risk is asymmetric. Downside can be fast. Conclusion. Final thoughts. Zcash had an incredible run in 2025, but today it's driven by leverage, dominated by derivatives, vulnerable to liquidation cascades. Short-term traders may find opportunities. Long-term investors should be cautious. Price can still move, but structure matters more than hype. If you found this analysis useful, make sure to like, comment, and subscribe. It helps the channel grow.